This is Duke University.
So thank you for coming here this afternoon. In recent days, with several conversations I've had with you or emails, it became readily apparent to me that there is a high level of angst and apprehension about what was going on in the financial markets, especially for those of you who are interested in a career in finance. So as a result, it became apparent to me that the school needed to address these concerns head on. And myself and others in the administration decided that we wanted to have an expert in global risk management come in to speak to you. And while we can't solve the problem, at least we can provide you with some insights and knowledge that should serve you well, whether it's in a job interview or just general conversations with others. Fortunately, we didn't have to look very far to find that expert. There is no one better able or better equipped to talk about what's happening on Wall Street and around the world than our own Professor Cam Harvey. Professor Harvey is one of the world's leading scholars in global risk management and has won numerous awards for his research. He received his PhD from the University of Chicago, where Eugene Fama and Merton Miller served on his dissertation committee. Widely quoted in the press, in fact, in just the last couple of days, he's been in Business Week and the Wall Street Journal. Professor Harvey serves as the editor of the Journal of Finance, the most prestigious academic journal in that field. And from the virtual town hall that he did last week, where he predicted what Treasury Secretary Paulson ultimately presented, I think you already know that he's going to offer you some keen insights into what's going on in the financial markets and how it will impact you and the world. So with that, let me introduce Professor Cam Harvey.
Thank you, Mike. What we've got planned today is a town hall, which means I guess I need to walk around and take questions. So I plan on making remarks only for maybe 10 minutes and then questions. And if you don't offer the questions, I've got a stock of questions I'll ask myself, some of which I can answer and some of which I can't. I will try to provide the insights. I'm not sure they're going to be keen, but I will try. It is a great time to be a tenured professor in finance. Why are you at Duke University rather than Wall Street? Well, this is also, while it seems like a time of great stress for you, going out in the job market in a year or 2 years. I'm also going to try to convince you that it's not as dire as people are predicting. Indeed, one of the themes of my remarks is that the investment opportunities that are going to be available in the next year are just historic in proportions. So it might be that the mix changes for the skill set in finance, but the demand for finance will be as high as it's ever been, and especially in the context of international markets. So it used to be that if you wanted a career in finance and you're graduating from a top school in the US, you looked at Wall Street. And we've kind of gradually moved away from it. And indeed, when I heard that we were announcing our globally distributed business school on the Monday, I sent an email on Sunday saying, no, can we delay that? Because Monday is going to be a day of news that will overshadow the globally distributed business school. Well, like in a way, it was a good timing, because the model that we're proposing in terms of kind of looking beyond the US is the model that will survive in the future, and this is a good example of it. That there are opportunities always in the world, and they might not be in Wall Street or be diminished in Wall Street, but there's 100 North Tryon Street, right? Do you know where that is? Yeah, Charlotte, yeah. So largest banking center in the US, I believe now. So There are opportunities in North Carolina, opportunities outside the US obviously are dying to get the expertise of top students trained at the elite business schools in the US. So I believe, and I say this up front before I talk about the details of the crisis, I believe that the reaction should be to diversify your search, diversify it outside of the US aggressively. There's plenty of opportunity, and there's plenty of opportunity, in my opinion, given that we're going to go into a period of high volatility, and high volatility for people in finance is not necessarily a bad thing. Okay, because if you're smart, you get in low and you sell high, and that's what we want to do. So I am not the doomsayer, though we're in a serious situation. And let me kind of go through my take on it. The other kind of fortunate thing is that you're here right now. You could have been working at Lehman Brothers right now, right? So you're here right now, and for me as a finance academic, we should not waste this opportunity because this is a historic learning opportunity. To have an event like this and in real time figuring out what the implications are, trying to analyze why it happened, what the right policy moves are. And I think that that will be something that potentially could serve you well into the future. So let's start with kind of my take on this crisis. And you know, I hate to keep saying, you know, I told you so, but I'm going to mention that a few times. And actually on the Fuqua website is a blog that I wrote 2.5 years ago that described my experience at the World Economic Forum in Davos. And I was one of the speakers there, and there were two particular opportunities that I had. And one was a cab ride that I had, was actually not a cab, it was like a limo, with Richard Shelby. So it was just Shelby and myself in Davos. I got his ear, and I'm saying, at that time he's chairman of the Senate Banking Committee. And at the time, I'm trying to make the case, you've got a problem in terms of risk management. It's not just investment banks, it's the banking system. We've got banks that are acting as basically giant hedge funds. So you've got risk that you don't know about, and there's going to be a bad outcome. And there was a second episode where I was actually a speaker at one of the events there, where basically made the same case. And let me kind of describe the case. Those, I guess I'm not teaching my investment analysis and portfolio global asset allocation course, but what we do in that course, and all the materials are up on the website, we talk about global risk management. And we talk about a particular mistake that people make. And it is a mistake that is stunning to me that people didn't learn the lesson in August 1998. Okay, August 1998 is when LTCM blew up, large hedge fund. Hedge fund that was run by, you know, the who's who of Wall Street, including 2 Nobel laureates in finance. Okay, one of them in charge of risk management. So what basically happened there was a series of mistakes. The first mistake was that there was extreme leverage used, like 100 to 1. The second mistake was that the credit that was extended using 100 to 1 leverage was extended at almost the Treasury bill rate, 25 basis points above government funding. Okay? The third mistake was the risk management systems that they had in place didn't properly assess the downside. Now, you might say, well, that's easy to say in hindsight. But in particular, what my research shows is that often what's assumed is that your distribution of payoffs have a normal distribution. It's easy to work with, analytically very tractable, but it's rare that you actually have that type of distribution. And you might look at the data, and it kind of looks normal, but if you apply 100 times leverage, it's definitely not normal. So you get these things occurring that don't make any sense. So LTCM experienced I think they said it was something like a 50 standard deviation event. Well, we can actually figure out the probability of an event like that. And you look it up. And the probability of that event, and actually you have to match the probability with looking at the data that drove them into trouble. You look at the data, you see a move that looks big, but not that big, but it's 50 standard deviation event. So the probability of that occurring is somewhere in the range of 1 divided by the number of atoms in the universe. So what does that tell me? The risk management system failed. Okay? This is also a situation today where we've got investment banks and banks doing risk management with leverage, using systems that don't put the proper probability on the tail events. Like, to me, the purpose of risk management is to look at the bad scenario and make sure there's a way out. Make sure you survive. That's not what happened. Okay, so people have talked about many different causes for the current crisis, and there's no one cause. Talk about the cheap money, where former Chairman Greenspan had negative real interest rates, effectively. It's a very cheap money. People have talked about bad loans being made, the subprime market, and this is all just part of the problem. When you don't have very good risk management, you often don't have very good kind of governance and compensation. And part of the issue today that I guess the lawmakers and the average people are kind of upset about is, why should the government bail out, Wall Street, when over the past few years, these traders have made millions of dollars and it's banked. Yes, some people have lost some money on their investment in Lehman and these other investment banks, but they've got millions of dollars. So what's going on there? So part of this is the so-called moral hazard problem. And part of it is that you've got the incentive to take a very risky position because the worst thing that can happen to you is, well, you lose your job. But the best thing that can happen to you is you're 100 millionaire. Right? So roll the dice. And even if you lose your job, you move to the next job. So we do have some problems with incentives that too much risk actually is being taken in certain operations. Can this be regulated? It's really difficult to do. Okay, and I want to talk about regulation a little later because the danger of the regulation is that it leads to capital flight. So instead of setting up your hedge fund in New York, you set it up in Ireland. You run your operations out of London. Okay, so we have to be extremely careful in actually doing that. So, so there are many different causes of what actually happened, and probably it's not that useful to go through and figure out what the causes are right now. I think what we need to address is what will happen, what should happen, and the sort of moves that are going on. Today, as you know, the Senate Banking Committee met and trying to figure out what to do with this plan. And it's a plan that I actually, as Mike said, was one of the people that were pushing something like this. Instead of nationalizing Goldman Sachs and Morgan Stanley, Washington Mutual, Wachovia, and potentially 1,000 other institutions, why not go to the core of the problem and start to buy some of these highly illiquid assets? So this is different. People call this Resolution Trust 2. Well, not quite. Resolution Trust was set up to dispose of the assets of failed institutions, failed S&Ls. Okay, the idea here is to go in and you don't let them fail. You create a market, you purchase some of these securities, inject liquidity into the market, and allow them to function. Okay? And some people are pretty adamant, and you heard some senators today saying, I don't think a nickel should be spent on this. That's what happens when you take risk. You make a lot of money sometimes, and then sometimes you lose. The problem with that is that the collateral damage is very significant for the whole economy. So what we're facing right now is a situation, the so-called credit crunch, but that means that it's very difficult for small businesses, medium businesses, large businesses, and the average consumer to get loans. Without those loans, the economy could significantly slow down. I don't think we're in a depression-like situation. It's much different. But there is a risk of what I call a deep recession. The last two recessions that we've had have been very mild. So 2001 lasted 3 quarters, and year to year, there wasn't a negative growth rate. The recession before that was also 3 quarters, very mild. And some people were saying, well, maybe this is the end of recessions. And amazingly, if you look at the data today, it doesn't really indicate that we're currently in a recession. Okay? It's a close call. And it's, to me, amazing that you could have oil, you know, around $100 to $140 a barrel. In the past, that would have been enough to guarantee a deep recession. You've got housing bubble burst, and you've got credit issues. We've had these credit issues for a year, more than a year. All 3 of these things together, and you're not in deep recession. Okay, so we're basically running flat. The last quarter, the growth number was a little skewed because of the government rebate program, but we're running flat. So we're not in deep recession, and the key issue is whether we will go into deep recession given the events of the last couple of weeks. So what can be done quickly to inject liquidity into the system to avoid that outcome? And I believe the policymakers definitely want to avoid that outcome. And the chairman of the Federal Reserve today said that if you don't act quickly, we will go into recession. Basically, he's saying we're not in recession right now, but we will go into recession. And I actually agree that if we don't get the markets fixed in terms of lending, then we are asking for very serious trouble. Okay, so that's, you know, kind of my initial remarks. I know I've got other things to say, but they will be probably a result of some of the questions. In particular, I could talk about how this mechanism of the $700 billion could work, and what are the implications, the AIG, things like that. So what I would like to do is to open it up to questions. There are 2 microphones. Yeah, I know you got questions. Microphone, please. You actually have to walk to the microphone. It's not going to be, see right there.
So you talked earlier about the difficulty of regulating. So that example of the trader you used, if the trader makes a lot of money, you know, if he doesn't make a lot of money, if he loses a lot, the worst that happens is he goes somewhere else. He loses his job.
Right.
But if the free market was really in practice 100%, and that trader lost a ton of money, that company would go out, and that trader would never be able to find work again. So isn't really the best regulation the free market, like it's always been?
Well, I guess the thing is that the trader, like John Meriwether, is a good example, right? That he drove LTCM to basically a 0 value, and then starts up another fund very quickly. So I guess the thing is that people, even though these traders might lose, they might get unlucky, people are still willing to invest with them, hopefully that they time it right. So I'm not sure what you can do with respect to regulation here. You know, there is, it's not just traders, of course, it's the CEOs, and they're the target in terms of the Senate right now. Like, should we have caps on CEO salaries? You know, and I'm the first one to admit that it doesn't make any sense for Dick Grasso to have a $250 million payday as CEO of the NYSE. But that's not his fault. You know, it's a flaw in the corporate governance. You know, compensation like that is outlandish. But I don't think you can regulate it away. You can create the conditions for good corporate governance. So I think that's important. The other thing is that I don't think we want to compress all of our salaries because one of the attributes of the United States and why it's done so well is that it is so freewheeling and it is so able to fund risky ideas. And where you do that, there's often zero returns, but sometimes there's big positive returns. And in order to create that environment, the environment of innovation, you have to have this big skew in payouts. To start to regulate that, I think, is going to cause a lot of problems.
My second question is do you think a lot of the problems that we're having now are a result of the Federal Reserve? So the Fed keeps interest rates so low for such a long time that you get this overinvestment in places where the investment isn't necessarily needed. So if we had a free market for interest rates, could a lot of these problems be avoided?
I'm not prepared to just point out and say this is a problem with the Federal Reserve. And I was certainly critical of former Chairman Greenspan in keeping the Fed funds rate so low. To me, looking at the data, didn't make any sense. Indeed, I traded against it and it lost money because it just didn't make any sense to me that they could keep the rate so low for so long when the economy was growing, but jobs weren't growing. So it's part of the problem, to have a policy like that. I wasn't surprised that they didn't drop the Fed funds rate from 2 to 1.5 or 1.75 because I really think that they want to keep out of that range, the 1% range, because that's, they're pointing the finger at Alan Greenspan as kind of the person that initiated it. I don't really think that's the whole story.
Hello. My question is, given this plan, and this was kind of the talk last night, so a lot happens in a day. I don't know if it's even relevant right now, but a lot of the talk was that by maybe making this a sort of a forced sale of these assets, when in reality the fair value down the road might be, say, 70 cents on the dollar, but right now, due to mark-to-market type accounting, the sale might actually go out at 30 cents on the dollar, and you're actually forcing these companies to take a loss so that their books can look okay for Wall Street. What would your perspective be, instead of the government coming in and consolidating this, of kind of relaxing the mark-to-market accounting regulations and allowing these banks to keep the assets on the books until maybe they're worth 70 cents on the dollar? And then, as a follow-up, what would you think of the markets and where we might be in, say, May 2010?
But the advice on the second question you have to pay for. On the first one, this is really, I think, an interesting aspect, and hopefully this is covered in some of the financial accounting courses. The real reason that Goldman and Morgan Stanley wanted to become bank holding companies has nothing to do with gathering these deposits that are FDIC insured. It has to do with the mark-to-market accounting. Okay, so basically, you've got FASB 115, which you should review. It's on the FASB website. And hopefully, many of you know this, that there's 3 different ways that you can account for the asset. And one is that you hold it to maturity. And the second one is you hold for sale. And when you hold for sale, any fluctuation in the value isn't reflected on your income statement. And the third way is that you're holding it for trading. Okay, so the problem with the investment banks is that they're traders. Okay, so their assets are held for trading, which means they're marked to market, and the details of the mark to market is FASB 157. And again, you should maybe review 115 and 157. Okay, and you'd be really informed on this. And that's what really caused a lot of the problems, because you're right that the fundamental value of the asset under kind of reasonable assumptions over the time horizon of the asset might be 60 cents, but the market is dried up in terms of liquidity, and there are very few bids, and the bids are really low. You have to mark to market, and you get into a lot of trouble. So I think that a large part of the reason to move in that direction was to get the more favorable accounting treatment. Now, can we go, at this point, it's too late. It's too late to get rid of or to switch it back to held for investment. So, because the investment banks are gone, effectively gone. There are boutique investment banks left, but they are effectively gone. So I don't think that some change in accounting regulations at this point, and people will study this, right? November 15th, 2007, FASB 157, okay? And they're going to study the implications of this in terms of what happened in terms of the investment banks. But the mark-to-market is definitely a factor. Given that we're talking about that, let me talk about kind of how this reverse auction, I think, is going to work. It's not even clear how it's going to work. I talked 2 hours ago to somebody from the Treasury and asked very specific questions about the mechanism, and they didn't know. So it's very vague right now, and maybe on purpose it's vague. But the way, effectively, it's going to work, let's say that we've got this giant, what I call distressed fund, $700 billion. And let's look at a particular security, some mortgage-backed security, and what the Treasury is going to do is to run a valuation model. There's plenty of these models out there. Hopefully their model is a good model. Okay? In their model, they're going to make assumptions that they're going to hold this for, let's say, 3, 4, 5 years. They're not going to assume that the current situation is going to be maintained. And they're going to get a price, a model price. And suppose that price for this asset is 60 cents. Then what they're going to do is to go out and put a notice out that they will entertain offers. It's request for offer. And people that are holding this asset will offer it to this giant distress fund. And you can think of a schedule of offers that comes between 50 cents and 70 cents. And with the reverse auction, you choose the lowest price. Okay, so in regular auction, you always get the highest, but given that you're buying, you choose the lowest price, and the lowest price would be 50, so you take everything from 50 to 60 cents. Now, at this point, it's not clear whether they would pay on the schedule of what you offered, or pay everybody who offered 60 cents and less 60 cents. And given what the chairman of the Federal Reserve said in testimony today, that they actually didn't want to go out and do a fire sale purchase. Now, the fire sale purchase might be a good thing for taxpayers because you buy cheap, but it could be a negative thing for the financial system. So I think what he's saying is we're not going to pay the fire sale price, which might even be below 50 cents in my example. What we'll do is we'll pay our model price, which we think is closer to the fundamental value of the asset. Now, my example is pretty simple. To implement this is a nightmare because all of these different assets have different characteristics. So it's not just one mortgage. It's many different types of mortgages, maturities, different features on it, derivatives layered into them, and not to even mention the derivative books that are out there. Okay, so this is not easy to pull off. But the bottom line is that some of this illiquid stuff will be taken out of the market at prices that are better than today. Some stuff, there's no bid. There's no bid. You want to sell, nobody will bid. Okay, so that situation is basically a breakdown of markets. There's no liquidity. So the 700 will help. Is it enough? I seriously doubt it. So just in terms of if we start seeing, just for example, in Alt A, which is kind of the next thing down from subprime, there's $2 trillion of Alt A. Okay, and if you look at just the prime mortgages, if there's leakage from the prime mortgages, that's going to be a hit. And I guess the thing that I'm worried about the most is that all the focus is on the investment banks, and maybe some of the commercial banks like Washington Mutual and Wachovia. You know, and you should be concerned about these banks and the other 1,000. But what about Ford? It's got $166 billion of debt. There's a lot of non-financials that are at risk right now. There's no focus on them right now. The good thing, if there's a good thing, it is that the leverage of the non-financial corporate sector has come down since the last business cycle. Okay, so they are, relatively speaking, in better shape. However, there's still a lot of danger. So what I'm watching for, you know, as a trader on this, is signs that the economy is really faltering. Okay? We've seen 7 months in a row of negative job growth, but we haven't seen really big negative numbers. Like other recessions, you see like minus 200,000 on non-farm payrolls. Haven't seen anything like that. Okay? And you look at the data, you know, housing prices, yes, have gone down, but it still seems like the economy is chugging along. Once we see a chink in the armor, then I think we're in trouble because it spreads beyond, you know, the financial institutions into the non-financials. And then the government's in real spot. Because they've been so generous to Wall Street, why not be generous to Main Street? Okay. Another question.
Hi. So what has been said is over a number of 3 years and so, the arms that were set in 2001 are now resetting. And of course, as the economy was doing well, there were a lot of these arms that were given out. Why hasn't a solution such as going back and renegotiating these adjustable rate mortgages with people been entertained at all? Because at the end of the day, if somebody assumed that at the end of 3 years I was going to be paying $300 for my apartment and now it resets to $1,000, there should be a way to renegotiate with the banks so that they can actually go back and make those payments over a much longer period of time. So why hasn't that been entertained?
Yeah, no, it's an insightful question. So let me just make a few remarks. The first one is that actually ARMs aren't looking too bad right now with the Treasury bill rate less than 1%. So interest rates have come down. So to be in a variable rate mortgage, there could be some advantage to that. But that's not really the point of your question. The point of your question is, like, why not just renegotiate? And that's exactly what's going to happen. So I think it's actually hard for the government to reduce the mortgage rate. You know, and indeed, they tried many times. They were slashing the Fed funds rate to try to reduce the mortgage rate. But the short-term rate was going down, but the long-term rate was sticky. And mortgages are longer-term securities. So it's difficult to reduce that rate. They can reduce the spread between treasuries and the mortgage, but really what we care about is the rate itself. So I think that what will happen is they are certainly trying to reduce the rates because, look, they've nationalized everything, right? The Fannie, Freddie, and they already nationalized Ginnie Mae. So when I look at the mortgage-backed securities, right? When I look at the Fannie Mae, Freddie Mac, you know, they should, allowing for the optionality of prepaying and stuff like that, taking that out of the equation, they're like government bonds. So the rates should come down on those. Yeah, but that's not enough. So reducing the rate, like renegotiating your fixed rate or changing the variable rate in some way, that's not going to be enough. Because the problem is that somebody's got a mortgage on a house that's worth $300,000 and their mortgage is for $500,000. Right? So reducing the rate by even a full 100 basis points, not going to help them. So what we will see is so-called cram downs. Okay, so a cram down is a type of bankruptcy lingo where basically what you're doing is resetting the principal. Okay, so you know, I think that that's inevitable. So the principal is sometimes so far beyond the value of the property that the bank has got a choice: either foreclose, which is very costly, and the more foreclosures, it affects properties around the property is foreclosed, and it's very difficult for the bank to sell the property, so they want to avoid the foreclosure. So you're going to see a lot of kind of resets, not of the rate, but of the principal. Now, again, we need to be very careful here as to how this happens. If the government forces banks to do this, then the bank might do it, but they're not keen on making new mortgages. And that's what we really want. We need the market to pick up so that people will actually be able to get a mortgage at a reasonable rate in reasonable terms. If the government starts going in and says that you must reset the principal on a whole series of mortgages, I think that they would have the same effect as kind of shooting in the foot. Okay, so you need to be very careful. Politically, it seems reasonable that there should be some legislation. Maybe there's some other way to encourage banks to do this. Banks on their own have the incentive to reduce the principal because of the cost that is imposed upon the bank of foreclosure. Okay, so it's very costly for them to do. So they need to work it out in terms of how much you can reduce the principal by. Very difficult to legislate. Another question?
Hi. So given that, we're going to be spending $700 billion or even more, what do you think the impact on the dollar is going to be? And do you think the US government, the sovereign credit rating is actually under risk? And my second question is, we actually had Eric Rosenfeld. He was, I think, third in hierarchy at LTCM.
Yes.
Come down and he spoke to us. And he actually said we were not 100-to-1 leverage, but that was what we ended up with. And that we were closer to 30-to-1 or something like that. Yeah. So, your opinions on that.
Yeah, he worked at LTCM, right. So he wasn't 100-to-1, but he was 100-to-1 in the end. Well, what counts is at the end. Right? At the end, he's 100-to-1. So let me kind of touch on a few things here. The first thing is that we've heard the politicians say, this is going to cost us $700 billion. Well, it could cost $700 billion. And that's the scenario that every single asset that the government buys goes to the value of zero. Okay, so that's the scenario of costing $700 billion. That is extremely unlikely, and given this scenario, it's actually the opposite situation. You're not just buying cheap, but the act of buying moves the market up. So I think that this is not going to be a cost of $700 billion. Now, it is true that the expected return on this is not going to be the same as if they were buying at fire sale prices. And as I said, Chairman said today, we're not going to do that. So we're not going to pay 10 cents on the dollar. Okay, so I think that in the end, there's going to be plenty of these assets that are purchased by this distress fund that will go to zero. But there's also going to be plenty that have, triple-digit returns. So I think that this is not, it's going to cost cash in the short term, definitely. Right? You have to have $700 billion to do this. And in my opinion, more. $700 billion is not enough. And it's interesting, it's been very vague as to say what qualifies. Like, what can we buy? They're not really specifying. Some people say it's mortgages. Well, it's not just mortgages. It's going to be all sorts of exotic things. They have to use their judgment as to what they should actually buy. Okay? Let me, given that we're talking about that, let me just make a remark on the AIG deal. Again, people say, well, it cost $85 billion. Well, it is true that $85 billion of cash went out as a loan. Okay? A loan that's got an interest rate of 11% on today's numbers. 11% loan. Oh, and also 79.9% of the company is thrown in. Okay, at basically a penny warrant. So it is no surprise to me that the investors in AIG are trying to undo that deal. Like, there's not one hedge fund in the world right now It wouldn't die to do that deal. It is the ultimate deal. AIG is a solid, fundamentally good company, right? Its stock price a year ago was $70, and today it's $5. Okay? To go and lend money to keep them going at 85 billion, 11% interest rate, plus get 80% of the firm, that is a deal. It's a huge, I believe that will be the trade of the century, and Paulson will get credit for it. Okay? Nobody close to it. And the problem, of course, the hedge funds couldn't do it because nobody's big enough to do it. And nobody could coordinate to get the funds together to pull something like this off. So they would have liked to have done it, but they couldn't do it. Okay, to the dollar, okay? And one of the imbalances in the world has been the dollar and our trade deficit. And people say, well, how long can this go on? How long can this go on? And I'm not going to make specific predictions as to what the dollar-euro exchange rate is going to be. But I think it's important that we kind of relate this to the fundamentals of the economy. The first thing is that it is possible that the US could dodge like a really, really deep recession with all of this, which would be good for the economy. It's not so clear that other countries are going to be so lucky, Europe in particular. So Europe could be hit harder economically than the US. Okay, so that's important to keep in mind. The second thing that's always important is to have the inflation equation in your head. And from your intro finance course or macro course, you know that equation, right? It's real simple. It's identity. It's very few things that we do in academic finance or economics that's an identity. But this one is M times V equals P times Q. So money supply times the velocity is the price level times the output. The output you can think of as GDP. And right now our GDP is flat. Okay? And then on the other side, money supply. Well, money supply has been growing at not a great, like a large rate, but recently with these injections, we're seeing some growth in money supply. The V is the problem. So the V has drastically been reduced. V is very difficult to measure, but we know that in a credit crunch, that V decreases, the velocity of money. And deleveraging, that is just reducing velocity. Okay, so one of the big calls is going to be what's going to happen to US inflation, which is very much linked to your question on the dollar. So if you've got a good view of that, then you can make some money on the currency trade. So you look at inflation-protected securities like TIPS. I think yesterday, the 10-year break-even inflation rate, was 1.9%. If you look at the chart of inflation over 10 years, like that is very low inflation. Today, it's 1.7. Okay, so, and I think that number is being confounded by so-called flight to quality. Okay, so, basically, if you believe the break-even inflation, it's saying that the velocity is basically going down by more than the money supply is being pumped up. Okay, so the answer to your question is an indirect answer, but this is the way that the currency people actually think about it. You need a view on inflation, not just in the US, but in other countries. I guess my view is that inflation won't be 1.7% average over the next 10 years, that it'll be more in the low 2% range. I believe that in the current situation that the uncertainty about the US has caused the US exchange rate to take a hit recently. But I think that a lot of these market reactions, people have a reaction, but then they start to think about the implications. So, well, one implication of the US being in economic trouble is that other countries follow it. Okay? And this is kind of an important teaching point, that as we become more globalized, it affects the correlations between economies. So basically what we're doing, and the growth in globalization, just amazing for the US. Over the last 15, 20 years, the size of the trade sector has doubled. There's extraordinary growth in the global sector, which is good in a way because we share our risk. So a lot of the subprime stuff, not held in the US, held overseas. So when that market disappeared or took a huge hit, it's not just people in the US losing their savings, it's people outside the US. And presumably they're holding diversified portfolios, and that is offset by some other positive in their portfolio. Okay, so there is some sharing of risk. And basically what this means in terms of the economy is that one country can have a slowdown, and it is muted by maybe some other country having some growth, and the country in the slowdown can have some strong exports. And that's exactly what we've seen in the US. That the last quarter's number was driven not just by the tax rebates, but by strong export sector. Okay, so we are, like in a way, diversified to that extent. However, and this is a big however, correlations change through time, and correlations are actually a function of the degree of the severity of the economic situation. So when we pass a threshold of weakness in the economy, then the correlations increase. And I believe we're at that point. So what I mean is that it might be a situation if US was having kind of flat growth, other countries could be, growing. But if the US starts to have like -2, -3, -4% real GDP growth, that's going to spill over to these other countries. So what people haven't done yet is done the analysis of the so-called economic beta. Okay, you have to look at the economic beta of these other countries, and then you come up with a view on exchange rates. So kind of a long-winded way to answer your question. In the short term, we're going to see some weakness. The U.S. economy has, the foundation to recover, and I believe we're on the path. Okay, it's a rocky path, though. So there's two questions here.
What's your opinion on short selling in relation to the current situation, and how do you feel about the recent ban on it?
I don't know if you saw the quote today in the Wall Street Journal about the short selling. They reversed a lot of what they said. So no short selling on financials, and then some were added, some were subtracted, and then, okay, it's okay to short sell if you're hedging, right? So I really believe that short selling is not the culprit here. Short selling is very useful in terms of what we want is the price to be meaningful in revealing information. And if you don't have short selling, if somebody that's got the negative information, it can't be incorporated in that price that easily. So what they do is if they've got an investment portfolio, all they can do is to take their holdings of that particular security to zero. Okay? And what they really want to do is not to take it to zero, let's say from 5% to zero. They want to go from 5% to -5%, right? And that reveals information to the market that could be very useful. The short sellers were the ones that revealed the problems, that asked the tough questions in terms of like WorldCom and Enron. There's many examples of very useful short selling. Okay? And I think you're talking about short selling in general rather than naked short selling, which might be a different situation, which could lead to squeezes, right, where there's more shorts out there than actual shares. And that's not useful in terms of the economy. But just the ban short selling, to me, is not a solution. And the way that they executed this, where they banned it and then they changed the rules, to me, it indicates that they really hadn't thought it through. And there's a lot of research, finance research, and this has been around a long time, and I think that this could have been executed a little better. Now, it's also the case that I guess the CEO of Morgan Stanley was very adamant about this. The shorting in Morgan Stanley and some other financials was, very costly for his firm. I guess the issue is whether those prices were the correct prices and how fast they got there. And hopefully, the one thing that's sometimes confusing to people is, well, so what if Morgan Stanley stock price is dropping? That's just the shareholders, right? So why should that affect the company, right? You issue your shares, you collect the money when you issued the shares, and then people are trading amongst themselves, so the stock price drops. Why is that going to drive them into a desperate move? And indeed, last week it seemed like they had 2 more days left at the rate of decline of their stock price. So what's going on there? And what's going on there is pretty simple. It is that the stock price is used in the valuation models for the debt and for the so-called credit default swaps. Okay, so they use a model called the Merton model. And Merton is one of the people at LTCM that got the Nobel Prize with Scholes for the Black and Scholes option pricing model. He's got a very famous model. And in that model, you look at basically a measure of leverage, which is the value of the debt divided by the market value of the stock. So as the stock price goes down, that debt, the CDS spread increases, and the debt becomes more expensive debt, more difficult to fund your operations, and you get into this spiral that you can't really get out of. Okay, so I'm of the opinion that there's plenty of other things to worry about, that the short sales should be put aside. There's, a lot of people were very negatively affected by this, and I'm hoping that the market will recover once these regulations have been relaxed somewhat.
So shortly after the Bear Stearns failure, the Fed issued a white paper which sort of laid out its vision on regulation. It said that it wanted to absorb the SEC and the CFTC. I'm just kind of curious to hear your ideal regulatory model going forward.
Oh, that's a question that I can't answer in 6 minutes. And I'm not going to be smart about the answer, like saying, well, no regulation. It's clear that there are negative externalities, and we're in the middle of one right now. And that's where you need regulation. So it is true that I think that amongst all of the people and institutions to point your finger at, we have to also point at the regulators. Okay? And it is so complicated, there's so many different regulatory bodies that there could be a logic to rationalizing that into one organization. But it's easy to say. It kind of makes sense in a few sentences, but actually pull something off like that is extremely complex. Okay, what we really need is flexibility. We need somebody to go in there and to figure out what's actually needed to do the job as efficiently as possible, where what we're wanting to avoid, obviously, is a situation like we've got today. But we also want to solve some of the inequities in the system. So regulation, we are into a stage. There will inevitably be regulation. And the cost, the huge cost that Goldman Sachs and Morgan Stanley, they've bitten the bullet here because now they're going to be regulated by the Federal Reserve Bank. Okay, and that's significant. That means that they have lost a lot of flexibility. Okay, so Goldman's leverage 24, Morgan Stanley 33, Bank of America 10. Okay, so they need to bring that leverage down. They've got a whole new set of regulations. Yes, they've got access to some Federal Reserve capital now. Yes, they will have access to FDIC when they get depositors. But what they do will change. And the thing that I worry about so much, and this has to do with your question of regulation in addition, is that you can make the case, as one of my colleagues has, Manju Puri, that there's a logic to having commercial banks do investment banking. Okay? But it's a different question to have all investment banks effectively part of commercial banks. And nobody's really done any research on that. And you lose something. You lose this kind of freewheeling risk-taking that has been the tradition of Wall Street, which has been the tradition of the US. The US is in the position that it's in the world because it's been willing not just to come up with ideas, but to make those ideas happen in terms of turning them into viable businesses. The people have been willing, in terms of private equity, in terms of these investment banks, to go in, set up the conditions whereby that idea turns into reality. It's high risk, it's high expected return, but sometimes it doesn't turn out. Okay? And I fear that we're going to lose that. And we could lose it in a quagmire of regulation also. And if that's the case, we're going to lose something very important for kind of the future growth of the US. And I strongly believe that could be the real hit here. Yes, I understand why Merrill Lynch had to basically merge or sell because it was a desperate situation. And I understand why Goldman Sachs and Morgan Stanley had to become bank holding companies because it's a desperate situation. That's just a fact of the circumstances today. It might be a result of their poor planning in terms of risk management, but the fact is that we don't have the same sort of financial system. And there could be a void in terms of what they did in the past. It's not going to be filled by the boutique investment banks that are still out there. They are a very small part of the market. So what I worry about, and I certainly hope what the policymakers worry about, though I don't have a lot of confidence on this, is the long term. Unfortunately, all the bias in our system, whether it is the trader or the CEO or the politician, they're operating for their bonus next year or to be reelected in the short term. And the main hurdle that we face is these decisions are being made with the short term in consideration rather than the long term. And I hate to lose that part of the economy. We have lost the investment banking part, and the implications could be serious. Now, I said at the beginning that I'm not the doomsayer here, and it's hardly the case. And I know we're at 5 o'clock, so let me just kind of circle back. The government has demonstrated that they will basically print their way out of this problem. Okay? And indeed, the chairman of the Federal Reserve, before he was chairman of the Federal Reserve, made this joke that we'll not see deflation in the US because we can always do a helicopter drop of cash. And it's a famous example that Milton Friedman actually used, which is true. Given that we're the reserve currency of the world, we can print our way out of deflation. People are saying this is just like Japan. This is not Japan. Okay, this is hardly Japan. So Japan, 1989, the stock market in Japan worth more than the US stock market. The Nikkei at 40,000. 40,000. Today, the Nikkei is at 11,000. Okay? Our stock market has not fluctuated that much. If you were holding over the last year, it's been a bit painful, but it has not fluctuated that much. That's difference number one. The real estate bubble in Japan, made the US look like, in former Chairman Greenspan's words, froth. It's a massive bubble. Number two. Number three, the policymakers in Japan were very slow to resolve the problems. They allowed banks to operate, and everybody knew these banks were zombie. Zombie being you're operating but you're dead. Okay, and they held it out for a long period of time. Number four, there are flaws with corporate governance in that the banks' boards were populated by CEOs of very large companies within Japan who made sure that their bank provided funding and credit for those large companies. And as a result, they starved the small and medium businesses. Again, this is, I think, the most important lesson of Japan. And I know the chairman of the Federal Reserve today knows this lesson. Okay? What happened in Japan, because a small business and medium business was starved for credit, that meant there was no growth. There was no investment. There was no employment growth, because small and medium businesses are the engine of growth in an economy. The larger firms are just kind of chugging along, more mature, and not necessarily hiring that much. So when you direct the credit to the large firms, then you are shooting yourself in the foot. Okay, so I think this is a very important lesson. The other thing is that they let deflation happen. And deflation is a bad thing for economic growth for the following reason. If you're deflating, why should you buy the good right now? Why not wait? Because you know the price is going to go down. So the longer you wait, the longer the price goes down. So I'm not going to spend. Okay? The sixth difference is, of course, the culture of saving in Japan is drastically different than the US. So somebody tries to make the case that our situation is like Japan, I don't buy it at all. Are we headed for a long period of slowdown? Yes. Relative to the last couple of recessions, each was only 3 quarters. This is going to last longer. And I've referred to it as kind of like a bathtub scenario. Okay, so you kind of, it's a longer kind of U shape. We'll see slower growth for a period of time that's longer than the usual slowdown. Okay, is it going to be 15 years long? No. Is it going to be a depression situation? No. Okay. Now, as for you, as I said at the beginning, you need to diversify your job search. Okay, I think that's obvious. Okay, but I would definitely, and I am kind of lecturing you on this. You know, don't make any assumptions. Diversify, and diversify outside the U.S. too. So be bold. There are jobs out there, and the great thing is that you're at a top school. If I was giving this talk to a 2nd or 3rd tier business school, it's a totally different story. Okay, so it means that you will have perhaps instead of 3 offers, 2 offers, or 4 or 3. Okay? It might mean that you don't have 3 offers in Wall Street, that you've got an offer in Zurich or Frankfurt or in Asia. Okay? But the demand for finance has not gone down. It's just been redistributed. And I think that, you know, given there's still a lot of uncertainties, a lot of stuff to work out, and there's a lot of politics that are confounding it, you know, I believe that we can get through this. I believe that the U.S. economy is sufficiently diversified that we're not going to go into a scenario that some people even refer to the Depression. I think that is extremely low probability. Okay? There is an investment environment out there that demands experts. The instruments that are out there, and these are instruments not just, you know, within the mix of these investment banks or financial institutions, are complex. They're more complex today than they've been in the past. It demands expertise like we're training you here for. So I would not be discouraged at all, because that works against you. And even though it seems like a dire situation, there are opportunities always. And as I said, for traders, these are fabulous opportunities. These are once-in-a-generation opportunities to buy at reduced prices. So I would go out there with a broader horizon, but very confident, given your training here, you're in a good shape to move forward. So I think that's 5 o'clock. Yeah.